A pig farmer from the 1800s created a chart that accurately predicted the Wall Street crash, the dot-com bubble, and the 2008 financial crisis. And right now, it's telling us something really interesting about where markets might be heading. I'm incredibly skeptical of market predictions. I've been investing long enough to know better. But when a chart drawn over 150 years ago keeps accurately calling major market turning points, I think it deserves our attention. Today, I want to share with you the Benner cycle, what it is, why it's been surprisingly accurate, and what signals it might be giving us for the years ahead. But even more importantly, I'm going to explain why relying on any prediction as the foundation for your investment decisions is incredibly dangerous. Let me take you back to 1873. Samuel Benner was a successful pig farmer in Ohio. Then, the panic of 1873 completely wiped him out. Devastated but determined to understand what had happened, he spent years studying price patterns in hogs, corn, and pig iron. His goal was simple: to identify cycles that could help others avoid the fate he'd suffered. In 1875, he published Benner's Prophecies of Future Ups and Downs in Prices, which included a hand-drawn chart forecasting market highs and lows using three distinct patterns. First, prosperity cycles. These followed a 16, 18, 20-year pattern. Second, commodity lows followed an 8, 9, 10-year cycle. And third, recessions followed 5, 6, 7-year cycles. Here's something crucial to understand. When Benner marked a year, like 1945 or 1999, he meant the end of that year, not the beginning. Benner's original chart only extended to 1891, but later George Trich extended it all the way to 2059, adding buy and sell zones marked A, B, and C. The chart tracks two different cycles: a major cycle following long-term prosperity, shown as a thick brown line, and a minor cycle, identifying shorter-term highs and lows, shown as a thinner gray line. Now here's where this gets really interesting, and frankly a bit unsettling. The Benner cycle has been eerily accurate at identifying major turning points. It flagged 1927 as a potential top. The 1929 crash fell right within that time frame. The end of 1999 was marked as a peak just before the dot-com bubble burst. 2007 appeared as a B-zone sell signal right before the 2008 crash, and the end of 2019 suggested caution. Then COVID hit just months later in early 2020. So after more than a century of mostly accurate calls, what is this chart actually telling us about today's market? According to the Benner cycle, we're currently in a favorable period that's expected to continue through late 2026. It suggests we should see rising prices and market strength until then. After that point, a potential top could form at the end of 2026, followed by a more challenging period extending into the early 2030s, with 2032 marked as a possible major bottom. Now let me show you the minor cycle in more detail. Those thinner gray lines on the chart are particularly useful for understanding short-term movements. Benner identified a repeating pattern in market fluctuations: 2 years positive followed by 5 years negative, 4 years positive followed by 7 years negative, 3 years positive followed by 6 years negative. These minor cycles create short-term peaks and troughs within the broader trends. Let me give you some concrete examples. From 1926 to 1931, minor cycle signals appeared slightly before the 1929 crash, potentially helping investors avoid the worst of the Great Depression's initial collapse. From 1996 to 1999, it flagged a bullish period, then anticipated the peak at the end of 1999. In 2007-2008, the end-of-year signal could have helped investors sidestep the bulk of the 2008 crash. Now, I need to be honest with you, not every signal has been correct, but these minor cycles do provide insights into short-term market movements that the major cycles alone don't reveal. But before we get too excited about this, let me share with you why I think this chart has actually worked. First, markets are inherently cyclical by nature. Agricultural commodities follow natural patterns. Solar cycles impact crop yields, which then influence supply and pricing, and these patterns cascade through the entire economy. Second, human psychology operates in predictable cycles of fear and greed, euphoria and complete panic. I've watched these emotions drive markets up and down throughout my entire investing career. Third, and this is really important to understand, the Benner cycle uses flexible time ranges. Those 16, 18, 20-year patterns provide enough flexibility to capture major market moves while allowing for slight variations in timing. Some predictions were off by 2 or 3 years, like the 1985 bottom or the 2012 low, but the underlying patterns still held in broader contexts, like real estate markets or the gold-to-Dow ratio. And here's the critical point. Not every prediction Benner made actually came true. This is incredibly important because of something called survivorship bias. We tend to remember all the accurate predictions, but we conveniently forget all the misses or near misses. Using predictions, whether they come from a 19th century pig farmer or a modern Wall Street analyst, is inherently extremely risky because predictions about the future are nothing more than educated guesses. They cannot account for geopolitical shocks, technological disruptions, unexpected policy changes, or black swan events. They certainly cannot provide advice tailored to your unique personal financial situation. The Benner cycle might help inform your awareness of broader market cycles, but it should never dictate your investment decisions. The much smarter approach is to build a truly robust investment strategy that doesn't depend at all on perfect market timing or predicting the future. So yes, markets definitely move in cycles, but betting your financial future on any single chart is pure speculation, not sound strategy. Instead, focus on what you can actually control: proper asset allocation, strong diversification, disciplined rebalancing, systematic investing, and an investment plan that's truly resilient to whatever the markets throw at us next.